Happy New Year. Hope everybody had a wonderful one. Of course, a safe one. And let's get on with 2023. So we're going to look at the market indices on a yearly chart. Put it in perspective of what happened last year in the context of a very long-term point of view. So I'm starting with the Dow here. And as I look at this, and I don't look at this every day, maybe a couple of times a year, because it doesn't change very much. But one of the things that you see is that since here where that bull market started, there was this period between 2000, well, you go back to the 90s, this is when back here is when I started to educate myself about the stock market, somewhere here in the mid to late 80s. And while this doesn't look like much, the markets, they started to go up. And believe it or not, this little red bar right here was a bear market, pretty extensive one. We're going to go down to the daily chart, so I'm not going to do that. And then, there was this period of kind of choppy move, and this is where the internet began in earnest around 1994, 95. And we had this big bull market, and then it topped out in 2000, and we got yield curve inversions and this big correction that occurred. And so you hear year by year, it never violated a prior bar's low as it moved up, and then there was this range expansion bar. And then a multiple year correction as prices pulled back. And this was here back in 2008. There was that financial crisis, and things cracked, and things come down to support, and things start moving back up again. This big bottoming tail bar, that's the pandemic. And this is where I think things really got totally screwed up in different ways. But I guess the first way, maybe whether it's true as to whether they truly, government officials, whoever, truly believed it was a pandemic or something manipulated, who the hell knows. Anyway, it turns out to be a farce from a technical point of view. That big bottoming tail is real. As prices went all the way back down and they came all the way back up, and it never broke a prior yearly low on a closing basis. And it whipped right back up again, and then it marches up, and we get this range expansion bar, and now a correction bar on the Dow, which breaks the prior year's low, but regains. And the Dow was the one showing relative strength. And so we're going to look at a few other charts in the same perspective, but as we go down into smaller time frames, we see more detail. But just for the moment, I'll look at this one, on a quarterly basis. It's where prices came back up. They pulled back to an area of minor support, as we call it, and there was some congestion there. And we go down to a monthly chart, and there was the reversal, and you can see a little more detail as to where the support actually was directly to the left. And now we've got a red monthly bar. Which way is this going to go? And as you look at so many of the smaller time frames, like dailies, it's just indecision. Which way are things going to go? There was a breakdown under all of these lows. It's been consolidating. There was a lot of bearish put option buying. Maybe that held prices there. Maybe it was the end of the year. And now we've got a breakdown, a little trading range, and which way it's going to go, above or below. We'll see in the next week or so. Just based on the pattern alone, I would say down. Now, there's no big range expansion bars here. That's a bit bigger, and you've got a red bar that was ignored, and then a bottoming tail bar. But it hasn't been able to move above here. And there is a void where the prices could come back up above. Well, and up to where? Well, the deeper it goes, the more it suggests, more of a trading range versus anything else. But typically, this kind of a pattern results in a break below the lows. As I mentioned, sentiment, which we'll take a look at in a little while, supports that prices could move up. So let's go back to yearly charts and take a look around at other markets. S&P 500 did not close below a prior yearly low. However, it's the biggest red bar in years. Now, I didn't calculate percentage-wise the size of this one versus that one, but, obviously more points, more could fall, and we could turn into a log chart. Kind of puts it in perspective of this was much worse than 2022. And so does this result in a consolidation? Probably so. Inflation is far from over. Or could it result in one of these? Several year pullback. Here, this big advance, this long what turns out to be a consolidation where prices break down and then continue to move higher. So we've got this red bar within an uptrend where prices retraced deeply but didn't close below a prior low. So as we go into this, what happens in 2023? Well, obviously none of us know for sure, but as we look at more things, we kind of get better ideas as to how things will play out. And so the question will be, do we break below a yearly low, right, in 2023? But we won't know for the whole year whether it's on a closing basis or whether it just comes down there. And does this turn into a red bar ignored or a bear sandwich where we get a following green bar, which is another year of going sideways, where this breakout occurred, red bar, green bar, and then may eventually 2024 things get straightened out with interest rates and inflation, where prices eventually resume moving within this uptrend to new all-time highs again. Looking at the NASDAQ, which got beaten the worst, technology, a close below a prior yearly low. And so the prior year, momentum slowed, the range of the bars narrowed on that year, and now we've got a red bar closing below that, which is suggestive more of, well, maybe not necessarily what happened here. I mean, this was a retracement. Stocks at that time went down around 90%. It was crushing. So the history doesn't, even patterns don't always relate to exactly the same thing is going to happen, because there's so many economic factors that aren't in effect here that maybe were here. The yield curves were inverted back here and they were here. But this was the internet craze and whatever craze, this was. But then there was the dealing with the pandemic and so on. So there's a lot of different things that have to be considered other than just the price pattern. So we can't assume just because we got a red bar, this is going down for 3 years. And as we look at what happened back in the 90s, this was just accelerating higher. Whereas, over here, there was some consolidation back here in 2015. And then we've got overlapping opens and closes here, 2017, 18, 19, and then it went higher. So we have more reference points of support. It doesn't mean it can't be a significant pullback, but we're just going to have to see how it goes. Clearly, we could see that this was damaged more than the S&P 500 and the Dow because of the effect of interest rates moving up. So as we go down and look at smaller time frames, that's a quarterly chart, we see the downside momentum is slowing, small candle body. Could this be where it begins to make a turn? Well, we'll be looking at interest rates during the year to see if they begin to back off, and maybe that's the case. Right now, it's lower highs, lower low bars. Momentum is slowing. It's not in an area of support yet, looking at this time frame. If we go down to a monthly, we see that this already tested that support, and now it broke lower, and we've got a red bar in December suggesting a break below here could take prices way down here. I think that's a real possibility if we see interest rates continuing to move up. Now the weekly chart, it's retesting the lows here. So it's declined multiple weeks in a row. We've got a bottoming tail bar. And this is why, the pattern here, as well as so much bearish sentiment, a lot of put options being bought into the end of the year where we could have some type of a bounce. So daily chart, at the end of the year, this broke down under the lows. We got a red bar ignored. We got a bottoming tail bar. It closed near the high. So if this can take out these highs on Tuesday, we should get some kind of a counter trend rally. Again, putting this in the perspective of this big picture, which says, hey, the best you could expect out of this is, even if it moves deep, is a trading range, not an uptrend. And if it fails, right, somewhere in between here, right, we're going to have some support, but again, we start going backwards on the charts. And it's like, how deep does this get? How then the retracement back down again? Right? Can it rally all the way back up to the December high? So as we get into the end of January, right, and even in the middle of January, we'll assess how far prices retraced or the lack thereof, and start putting things in a better, I guess, more confident perspective as to how things are going to unfold this year. As we look at this, again, from that longer term perspective, it's more supportive of prices coming further down into this area of major support, very significant support, and it's a pretty wide area coming down into there, where maybe at that time the Fed will be done raising interest rates. We'll see longer term interest rates beginning to pull back, and things start to come together where we would have a much more bullish bias from a longer term perspective. And we'll see how that all lines up. I'll just look at IWM here. It doesn't have as much data, but you can see the breakout failure that occurred on the monthly chart, and it's just been whipping around here for half the year, give or take, just whipping back and forth, and a monthly red bar, and you can see the yearly close below a prior year's low, and there's the pandemic whip around, and so on. So it looks like more correction is coming. To what extent? We'll just have to see how it plays out. So let's take a look at our other charts. Just flipping around here, the other things that we take a look at. And so agriculture. So this was just moving down forever. And then the pandemic, there's going to be shortages and the big rally and inflation. And it's just been doing nothing here. This is a quarterly chart. Base metals, that rallied up and that, came back down. And commodities, that went up, wide range bar ending, and that's just been chopping around here. Now, interest rates, you got the 10-year interest rate here, right? That topped out. This was the big inflation time in the 70s, and then the runaway in the 80s, and then, the top in interest rates and the long-term decline, and big turnaround, and the inflation created by printing all that money during the pandemic. And it really screwed things up, because this could have just continued to go down or flat for a while. And the hangover from printing that money, it's going to go on for a while. And what else more can we say? Is just see how things unfold with these increases in interest rates. And you go back and look at the history of the 70s, there was a lot of interest rate increases that didn't help for a long time. Hopefully we're not in for the same. Ultimately, they're stalled here at this resistance, and they can continue to move up to that next level, which will be much stiffer as a reference point up around 5%, and that's the 10-year. The dollar on a quarterly chart, that reversed back down. This is emerging markets. It moves inverse with that. So we'll see if this unfolds. This is, again, a quarterly chart, but as we go down to smaller charts, which I'm going to take a look at in a sec, this just looks like it could pull back more, but it's in a solid uptrend. Bitcoin, big green area down here. Until proven otherwise, it looks like that has to come down there. That's where the significant support is. S&P 500. Now, if this was a daily chart, because it doesn't matter the time frame we're looking at, I look at something like this that moved up. It attempted to turn around. Now, it didn't take out a prior quarterly high, but we got a green bar. Can it take out that high? Which would be much more bearish if it fails, but even, there's two topping tails and smaller topping tail, a break below this low suggests a measured move lower down here toward this 240 or 250 area. And we'd see that the volatility probably, I'm sure, would spike up if that was to happen, and why we keep an eye on these prior reference points. But right now, it's just been hanging up here. And energy had this deep retracement. So energy was the big winner this year. It's due for a consolidation. It has been consolidating, but a lot of the energy ETFs, most of them, they look pretty darn good still. So I think a lot of people are counting them out for the year, but I wouldn't count them out. We'll have to see. Blackstone, advisors. This has been coming down. I'm going to flip this over to a monthly chart. This is something that suggests more pressure is going to be on the markets, because these typically turn up at the beginning of a bull phase and turn down at the beginning of a bear phase. And on the monthly time frame, where this attempted to move up and failed, we've got a red bar, and this looks like it needs to come down to this major support area, green. So if this is going to come down to support, where buyers will show up, that supports the S&P 500 eventually breaking these lows and coming down to that lower level. Interest rates on the monthly, they turned back up. They were pulling back and turned up. So this could be signaling that we're heading up to that 5% level, where we would look for them to top out, and hopefully the Fed to be at a point where they're saying enough is enough. Right? And then the markets start to settle in on the worst is over, and a bottoming process. So the dollar looks like it needs to be pulling back a little bit more. And you see now you've got the red bar here as it started to pull in. And let's just go to the weekly time frame. And so you see the 10-year moving up to resistance. What will it do there? It's in an uptrend. In uptrends, the assumption is it's going to take it out. So if this is going to be taking it out, the implications for the markets are going to be bearish. And it's going to be bearish for some sectors that right now have benefited from this little pullback, like construction and home builders. So we'll be taking a look at that. All right. Energy, all right, pulling back here. I'm going to show you the ETFs. This is DBE, which encompasses, more than just those ETFs. We'll take a look. You can see Blackstone, the breakout and the failure. So let's continue here. We don't get too long, but monthly chart interest rates, short term, flattening out, and the 10-year stabilized, but still in a solid uptrend. Yield curve inverted. This is the same 10-year note. Bullish sideways price action at resistance, like it's going to continue to go higher. S&P sideways. They end of the year just can't make up their mind. Now, sentiment, right, being at an extreme, supports that this could bounce up. Well, S&P's bounce up to where? These converging moving averages. This 4,000 level has a huge open interest in puts and calls. It's like a stalemate. They're almost even. But maybe that acts as a magnet. 3,900 will be a big level to get through. And if it gets through that, I think it could move up to 4,000 with relatively ease because of all that options activity up there. But we've got to see that happen to get above that 39. Going below these lows, I think it'll be a quick, short drop down into this support area here. And we've got the NASDAQ 100's already at support. What will they do? What will technology do? I think they'll be breaking to new, not all-time lows, but new lows compared to 2022. Breath has ground its way up to zero, which typically it rolls back over. But we got sentiment at such an extreme. There's a lot of conflicting information. And, I would have went to longer time frame charts anyway because it's the end of the year. But whenever there's these conflicts in time frames and information, you got to go to higher time frames and see what makes sense. And I think overall things make sense that we're going to see more of a correction. But in the short term, because of sentiment, maybe we could have a little bit of a a reprieve here at the beginning of the year, but we'll see. Go to year-to-year charts and see what happens at the beginning of the year. They just typically follow through over the years to what was. In 2022, things tried to follow through, and we were already anticipating there was going to be trouble in 22, and immediately in the first week of January, it was a breakout failure. And then we started bear market. Just a line chart I like to look at. It's just been chopping sideways here. I'm not sure which way it's going to go. As already said, yield curves 3 by the 30. Inverted, there's been some improvement. 5 by the 30, there's been some improvement. It's right at the 0 line, and this is the 5 by the 10. What we need to see in 2023 is that these yield curves get positive. They're not going to get anywhere near what is long-term extremely bullish, because the Fed would really have to start easing, but you'd have to see them getting up above 2.5. That's going to be coming next year. Believe me, as it unfolds, you'll know. Monthly charts looking across the board here. We already looked at the S&P. And so as I look at this, what is it? Well, it's a trading range. And I wonder, could it be a head and shoulders bottom where things turn up here? Or does it go sideways and break down? You see, I got my alert down here. Industrials, we already covered, they've been stronger. Materials were stronger, but we got a monthly reversal bar at resistance after a breakdown. Aerospace and defense, sell setup. Now, computer software, it's just pulled toward this support level and just did nothing for so many months, which leads to, is it building an area of support, or is it building a new launching pad for prices to dive lower? You see Tesla here, that looks like it's going to dive lower. Consumer discretionary, that broke down and made a new low at the end of the year. That looks like it's got to go down. Telecom's just whipping around here. Retailing. Well, it was multiple times this looked like it could turn up, but failed. So we have a lot of lines in the sand to set alerts to be aware if prices break to the downside, or do they break to the upside and move on to other things rather than paying attention to what isn't moving. And so the Russell 2000, I've got my alert here. The transports, this new low, but it couldn't get very far. The monthly turned down. And the Qs, which we've covered, they just look like they have to go down. Now, it's not a good picture. Maybe the worst is over. But it's gonna be difficult, I think, at the beginning of the year, no matter where we look. So, financials roll back over. Insurance companies, that deep retracement, but at this pivot high. So I like the wide range bar. So one of the themes that you should look for with these turns are what I call range expansion bars. And they simply should just jump out at you as something. Hey, that's a big bar. We don't have to measure it. Just compared to the others, that's a big bar. And the depth of retracement is one where insurance companies could be a winning sector if it could break out above these highs. Broker-dealers, indecisive, did clear these highs. We'd need to see a red bar ignored, which means a whole month of January holding this low and turning into a green bar. And if we had that, we'd be saying buy this above the highs. But if January is pushing down into these lows, the whole thing begins to change. And we're just back into that point, the idea of a trading range versus something that could go up. Banks, that doesn't look good. Breakdown, sideways, we see a lot of that. Now here's the home builders and home construction. And they've been chopping around here. You see they backed off at the end of the month as interest rates started to go up. Now if interest rates, that 10 years continues to go up, if the 5-year continues to go up, this is going to break down. And so if this is breaking down and construction's breaking down and all these other patterns start to follow through lower, clearly it's going to be ugly for a little while. and things are going to come down to levels of support, and the whole cycle will begin to change, where we'll be keeping an eye on interest rates and everything that I mentioned to look for those bottoming patterns. Healthcare has been doing nothing for a while. Pharmaceuticals, chopping around. Lots of indecision, no matter where you look. Right? Now, as we look at crude oil, and here's USO, the ETF. This looks pretty darn good. And it's a monthly chart. Uptrend, pullback, bottoming tail bar. If this can move up, look at OIH. So this is done well. It's at this pivot high. We've got a range expansion bar, and now a bottoming tail bar in December. Above these highs, energy could be another winner again this year. So we'll keep an eye on crude oil. And this one here is gas and equipment. It's got a similar pattern. It's been consolidating at resistance. Can it clear the highs? Gasoline. Well, we don't want to see our price of gas going up, but we had this dip, and now we've got a bottoming tail bar on the monthly time frame, and it broke these lows. That's bullish. It's in an uptrend. So this says oil can go up. Gasoline, of course, is going to follow oil, and these energy sectors are going to follow gas and oil. As we go through the charts, we see a lot more indecision. Gold, maybe, in a big trading range. Steel trading range. Copper miners, that broke down. XOP doesn't look as good as these, but it's consolidating, a little more sloppy. Bitcoin we looked at, that looks lower. Silver broke down and just V-bottomed back up again. We looked at the home builders. Solar, if this could be a red bar ignored, it'd be a screaming buy, I think, because it's held up, tried to hold up in bottoming. But if it can take out the high of that red bar, I'm just sending an alert. If it can take that out, that's a buy. Utilities are just a mess. And so as we go into this new year, there's what we call the factory work to continue to monitor all of this. And until things come together, I suspect that it won't be easy. But when things come together, that's when it gets easier. And I think that there's going to be a lot more of what worked last year, which was lots of credit spreads. And Dan did phenomenally well with selling naked options on something new that he started doing this year, but selling naked options on stocks that are going to report earnings. So the premiums go up significantly, and using the charts as we always do to get so far away, I think his batting average was in excess of 95%, which is just unbelievable. So there'll be more of that. And as always, if there's questions as the year goes on, don't hesitate to email us, Greg at Master Trader and Dan at Master Trader. All the best in 2023.